Welcome to Share Views, where we are here with investor Jim Mellon from Burnbrae Media Limited. Is that fair description? One of your activities.
Yes.
But another activity we talked about just now was Nigel Farage's annual. It's supposed to be his annual celebration now, isn't it? It's going to be every year now. It's going to be sort of.
Well, if someone pays for it, it was a very lavish party. And what was funny was that he came around with a tray of Ferrero Rocher ambassadorial chocolates, which I thought was hilarious.
That must have cost at least £5.
Well, yeah, I think that was the cheapest part.
The cheapest part of the event.
But, you know, this was the whole of the kind of salon area of the Ritz, and the Barclay brothers presumably had paid for it, and it must have cost a good, well, many thousands of pounds. It was quite a hilarious party, actually.
I mean, there is actually a serious message for the markets and beyond on this 2016 being the Brexit year, the Trump year. And
the Euro breakup year.
And the Euro, I want to get onto that, but I mean, at least in terms of the anti-establishment feeling, because it's not a left-right thing, it's an up and down thing, isn't it? It's the little people and the big people, and a bit of a revolution.
Well, I agree with that, and actually I was doing my research for the talk I'm giving tonight, and I was stunned that if you'd invested $1 in the S&P in 1980, have a guess how much you think it's worth in inflation-adjusted terms. Inflation-adjusted. Not just nominal. Have a guess.
I'm looking for $150, I'm hoping.
Well, that's a really good guess, 131, all right? And $1 of average median income in the United States, inflation adjusted between 1980 and today, what price is that $1 now?
About 15 cents.
No, it's $1.
Oh, really?
So the incomes have not risen for 36 years, and the stock market's gone up by 131 times in inflation-adjusted terms. And that, I think, says it all. So if you look at the voting patterns for Trump, it wasn't gender-biased, it wasn't race-biased. He did better than Romney in both with women and with ethnic minorities. It was basically the typical, the squeezed middle class who feel they're not going anywhere in America, and yet they see all these fat cats benefiting from dramatic uplifts in asset prices, partly due to the huge expansion of central banks' balance sheets since the financial crisis and the continued manipulation since then, basically.
But we knew that because we knew at the time 2008 is the first time I heard the term moral hazard, so that came through, and then the unintended consequences of having a zero interest rate, where all the people who were good and saved up suddenly don't have an income.
Yeah.
Especially when they're old, and all the people who bet the farm on property going up or any other nefarious activities were saved or rewarded. So the last 8 years have really been the killer blow to cause this political upheaval.
That's correct. And if you've been close to where the money is produced, if you're a central banker, you're an elite, you're a highly leveraged person, or you're just in Wall Street generally, you've done very, very well as a result of this. And then the typical guy in the US, the average household income was about $51,000. That's the same as it was in 1980. So people talk about how real wages haven't increased in the UK for 8 years, but we're doing a lot better, relatively speaking, on a per capita GDP basis than the United States. Now, as all this zero interest rate stuff and zero productivity growth stuff has been occurring, of course, we've also had tremendous automation. So people are being automated out of jobs, and they're getting other jobs, but they're typically lower paying or less secure jobs, like driving Ubers or renting out their flats for Airbnb or whatever. And so
people.
Well, I think your pay is going up, actually.
Obviously,
as your fame increases
by the minute.
Yeah,
right. But you have the technology, but you've also had. I mean, this has been a very contentious issue. The globalization of the workforce has meant that people are going all over the place, and they're competing not only in the third world, they're competing and goods are being produced there much more cheaply than in the first world. But then some of the people are coming from over there to over here. So it's a real hodgepodge of largely negative factors if you are somebody who's been in the West all this time.
Well, I mean, I think that's true, but actually, more than people moving around the world, companies are moving around the world, and these companies, which I call monopsonies, they are basically the monopoly of people, and so they determine where they will site their situation, like say for Google as a good example, or Facebook, and based on how cheap the local people are relative to their production, which is typically a software production or an electronic production that can be disseminated around the world. And so in a way, they're driving down wages as well, because they go to wherever both the tax rates and the people are cheaper. And countries are now competing to get these monopolies to come to them. Like the UK is competing to get Google and Facebook against Ireland. And they're using corporate tax rates, incentives, free free offices and stuff like that to get these people to come across. So in a way, and some of this is being driven by corporations and not just by government incompetence. And let's face it, it is government incompetence, because it was right to do QE in 2008, but it wasn't right to carry it on ad infinitum. And they've really, I think Donald Trump's arrival, Donald Trump, not Brexit or anything like that, represents the end of an era, the end of this growth deflationary era. And we're now going to go into exactly the opposite, and we have to do the opposite in our investment strategy.
So that's the crux of the matter. How do you make money out of this? What's been quite a painful-looking landscape?
Well, the stock markets have gone up post-Donald Trump, and they've gone up basically, I think it's kind of a relief rally, but it's also an anticipation of a cut in US corporation tax from 35% down to 20% minus. So it could be 15 to 20%.
That's massive, isn't it? That is a massive move.
It's massive, but in my opinion, it's priced in. And also, 1/3 of US corporations pay less than 25% tax already, because they use various devices to do that. The second thing is that there's $2.6 trillion of US corporate earnings offshore, which hasn't been repatriated because it's unfavorable from a tax point of view to repatriate it. He's going to do an amnesty on that, and I would imagine he'll tax it at 10%. And a large part of that, I think, will come back to the United States. As when the last amnesty occurred, which was in 2004, almost all that money will be used for corporate share buybacks. That's all anticipated by the market. They know that that's going to happen. It's possible that his cuts may be resisted by Paul Ryan and the Republicans in Congress, and he may not get the full 15%, which is what's priced in at the moment. But let's face it, in 1981, when Ronald Reagan came to power, US Treasury bonds were at 13% interest rates, and the stock market was selling at 8 times earnings, and earnings were about to go up. Today, you have the Shiller-adjusted PE ratio of 26.6 times, and earnings are going down because margins are getting compressed, and also the strong dollar is reducing the earnings potential of US companies. And you have interest rates still, despite the bond rout in recent weeks, at very, very low levels. So we go into this revolutionary change with very different circumstances. That the US stock market is too high, in my opinion, and it's not got a lot of upside. And the bonds still have tremendous downside, because the one thing that is going to happen is that inflation is going to come back, and it's going to come back with a vengeance, because you can't keep on printing money forever without some consequence, and that consequence is inflation.
Well, there's a couple of issues that you've cried wolf on over the last few years. First is the breakup of the Eurozone, Euro itself.
Well, I've always said that my time frame was 3 to 5 years on the breakup of the Eurozone, since I started talking about this. And I only started talking about sell bonds in the last year and a half.
But on the bond market as well, which is my real point, not trying to say, well, you got it wrong or you got it right or whatever. It's actually that the authorities have massive firepower. I mean, they can basically hold the world up, even if it's going to sink. With the Eurozone, they did that in 2012. And also, when interest rates are at 0, you can print as much money as you like, and you don't have to pay it back. So, in theory, so basically, they can keep throwing money at the problem. Both, if the bond market was threatening, they can do that as well. We're so centrally controlled. We might as well be China in terms of, the Eurozone or the bond market. So your bonfire of the vanities, which I thought was a very witty title for an article, may not actually burn in the way that you're looking for it to burn.
Well, you make a good point, but there's a point at which further government intervention or central bank intervention in the bond market becomes unproductive, and they more or less all reach that. Okay, so to give you an example, in Europe, the ECB has rules that say you can't have more of a percentage of a country's bond issue on the central bank balance sheet, and there's a GDP per capita or size of economy factor in determining which bonds you have to buy, which is why they were buying German bonds, which is the last thing you want to do because the Germans don't need interest rates at very low levels. They need, normal price of money. But in order to be able to buy Italian bonds or whatever, Spanish bonds. And Germany will not allow, in my opinion, the ECB to do further massive monetization of Southern European fiscal problems, basically, which is what this is all about, or debt problems as well. And so if you look at the current situation in Italy as being a precursor to what I think is going to happen, there you have debt to GDP of about 140%. You have youth unemployment, which is through the roof, and you have high general unemployment, and you haven't had an industrial production increase in Italy since 1994, nor an economic increase since 1998. So the country is a basket case, and the reason it's a basket case is not because the Italians are stupid or badly governed. They are badly governed, not because they're corrupt. It's because of the imposition of the one-size-fits-all monetary policy without an equivalent fiscal policy on the Italians and other Southern European, more fragile economies than the German economy. And the Italian referendum on December the 4th is not a vote about changing the Senate and the voting pattern on the Senate. It's a vote of confidence in whether Italy's role in the European Union and Mario Renzi's sort of kowtowing to Mrs. Merkel is the appropriate thing. And I think, even though opinion polls have been very wrong recently, they will vote against him, and then you start the train of the euro breaking up, because one big member leaves, that's the end of it. All right,
but it'll be like the Brexit thing. Well, it'll just be, it was advisory, and it was had to go to Parliament, had to go here, had to go to the High Court, has to go to all over the place, and it's too expensive, and it'll be too disastrous for the Italians to leave. And that's what's going to happen.
Well,
so it's going to be an extended fudge. We've already got that from here, but it'll be an extended fudge, and the politicians are just great at kicking the can. So, it is supposed to be, the smart money now is saying that there'll be Eurozone breakup, within, let's say, a year or 2 years. But the ability of these chameleons in power to keep going, we'll have Merkel keeping it going so she can get a fourth term. You have all these things going on. So, I'd love to see this all happen. It's be a great spectator sport, but it's amazing how the establishment and the system is still very, very powerful.
Well, you tell me how, if the five-star movement in Italy comes to power, which is a possibility, and their motto, this is the party motto, not just a sort of informal one, is F off. That's their motto. If they come to power, how can Merkel stop Italy from leaving the euro? And of course, the first person or the first country to leave the euro is the one that has the advantage. And they may just do it overnight. They may just say, we're leaving the euro, and that's it. All the Italian banks are already bankrupt.
That's what they should have done here. They should have, June the 24th, there should have been Article 50 vote, and that's what the people wanted. But there, it'll be the same situation as here. So we would love to leave, but we don't have the money because you voted this way. We've run out of money, and we're just going to go bust if we leave. So it'll be, the pattern there, I think, is because obviously they are bust anyway.
Well, that's the point. So that's the point I'm making. We're not bust. We're not bust in the UK. All right, not yet, and I don't think we will be. I'm quite optimistic on the United Kingdom, but Italy is bankrupt. All the banks are bankrupt. But the effect of Italy leaving means that every single continental bank is bust.
So there will be a domino effect. There's a domino effect.
100%.
Nobody can wriggle out of.
And it was hard enough to rescue Greece, which was about a 350 billion euro problem. The Italian debt is somewhere between 2.5 and 3 trillion, and the French debt is about the same. There is no way that Germany, even with all its supposed might, can rescue these countries or can staunch
printing money.
Why would printing money help to maintain the euro? It would have the opposite effect, in my opinion. Buying the bonds directly from the Italian government, the Germans are not going to allow it. So Germany is in a very, very difficult situation, and speaking as a man where most of my assets are in Germany, I can try to work all this stuff out. What is going to happen, all right? Because Germany will, I think what's going to happen is that one of the members will preemptively move, and they'll do it not to leave the European Union. They'll try and stay in, but they'll just say, we're leaving the Eurozone, we can't put up with this anymore, our whole generation's been lost, and all that sort of stuff. When they do that, the domino effect will occur. And how does this get paid for? So the way I look at it is we've had bank bond bail-ins, but I think the depositors will be bailed in across Europe. I think if you've got 100,000 euros in a European bank, they're going to take 10% of it and give you some Mickey Mouse shares in the reconstituted future bank that will be refloated at some future point. Now, what will happen is that the bond prices of, let's say, Italian bonds will go down in currency-adjusted terms by 50% on the day that this happens, all right? And I don't know if you've seen that the morons at the central bank, the European Central Bank, and institutions around Europe were stupid enough 3 months ago to buy, in the case of Ireland and Belgium, 100-year bonds. I mean, we don't know what's going to happen next week, let alone 100 years, all right? And they're already down 30 to 40%. That's duration risk at its most extreme. They'll be down to pennies in the dollar very, very soon, because they're just ridiculous bonds, issued at just the wrong point in the cycle for people to be buying them. The Italian bonds will go down 50%, and the German banks that hold Italian bonds, and the Austrian banks that hold Italian bonds, the Dutch banks that hold Italian bonds, they're all bust. So you have to bail in not just the bondholders, but the depositors, and effectively nationalise all of the banks in continental Europe. And some of our banks will be affected here, but not very much.
Right, Jim, we're just about out of time. So it's sell the euro. Any other mantras for the next few months?
Well, it seems obvious to me that post-Donald Trump we should sell all bonds. Yeah. And euro going to have intermittent rises, but I'm sure it's going to go down below parity with the US dollar. In terms of precious metals, they've gone down. That's almost counterintuitive since Donald Trump came in. I think part of that is the Indian situation with the note changing. But I think today you should buy everything related to gold and silver. Now, it may be that people will carry on selling for a while, but gold and silver are bound to go up because we do live in a world of new inflation. We live in the opposite world to what Ronald Reagan saw in 1981. We should do exactly the opposite of that. Gold went and silver went down when he came to power because equities and bonds became very good buys. The opposite is true today. And I would sell all the internet darling stocks, Amazon, Facebook, Tencent, all these ones that have got crazy valuations. I would sell them because they're probably the greatest shorts that you and I have seen in terms of the size ever.
Jim Mellon, investor, thank you very much for speaking with us on Share Views today.
Thanks, Zach.